Good morning, everybody, and welcome to a special post-reporting season briefing for Byron Capital. I'm joined this morning by Mike Hawkins, who's a portfolio manager here at Evans Partners. Good morning, Mike. Thank you for joining us. Mike, just to kick off, the last 6 months have seemed like a tough environment in markets. Could you give us some insight as to the key issues?
Yeah, it's been a bit of a grind, hasn't it? Had good months and bad months. The Australian market has pretty much gone sideways, I think, for the last 2 years. And the basic problem in Australia, and to a lesser extent elsewhere, is the profits aren't growing. Right. And the profits aren't growing because there is industries facing structural problems, and the economies, of course, are probably locked in second or third gear. So, the big drag on the Australian market remains the fact that the earnings per share hasn't grown across the marketplace in over a decade. And unfortunately, I think that drag is still going to be with us for some time. The other big observation, of course, looking at fixed interest markets and cash markets, is that the interest rates have continued to fall or trend down, and the returns from those interest-sensitive investments are also being quite soft.
Mike, you keep a close eye on Byron Capital's asset allocation. What would be your key thoughts as to the way we should be positioning portfolios at the moment?
Well, let's reflect on the trends of the last 18 months, 2 years. Generally speaking, we've maintained a fair bit of cash on the basis that the world's got problems and valuations have generally been pretty full in equities. So I think that's worked relatively well. The other big trend, I think, has been to, within the equities exposure, is to put more overseas relative to Australia. And I think looking at the balance strategy today, we technically do have more allocated international markets than Australia.
Absolutely.
And I think that's the right decision for the next 20 years, and hopefully the right decision, as it has been for the last 2 or 3 years, in the near term as well. Because it's just simply a case of opportunity set. We get a far broader opportunity set in terms of the quality of the businesses that we can access overseas.
Sure.
The little challenge we've got now, of course, is with the Aussie dollar starting to bounce along sideways.
Yep.
We have to ensure that we can manage that currency exposure, because when the Aussie dollar goes up, the Aussie dollar value of the international assets is suppressed. So we want to try to lock in low Aussie dollar valuations where we can.
And Mike, we're not long finished the Australian company reporting season. What have been the key things that you observed over the last few weeks?
Yeah, I sort of touched on it earlier in terms of the profit trends. In some respects, while we did see the analyst forecast for financial 17 and 18 come down a little bit, it wasn't too brutal, particularly for the mainstream industrial companies. We did see further mild downgrades to the banks, which has been a trend we've seen now for the last 4 or 5 years. So the earnings outlook there is flat at best. Where we have had a little bit of good news is the commodity prices are a bit stronger, of course, over the last 6 months, particularly coal, particularly coke and coal. So I think in aggregate, that's sort of, again, put a floor under the earnings estimates for the resource companies. We're not totally convinced that's sustainable. So from a portfolio perspective, we're not aggressively running in and buying mining stocks, but nonetheless the broader profit picture in Australia I would still say is soft, but at least those numbers have stabilised, which is one of the reasons the market has been able to recover since the tough start to the year in January and February.
Yep, absolutely, yeah. And Mike, looking forward over the next 6 months, what would be the key concerns or even opportunities that you'd be looking at?
Yeah, well, I think it's unlikely we'll reach a point where we're going to say, right, we want to put a lot of money back into equities. So the thing I've been focused on over the last couple of years, I think the opportunities are coming up more at the stock level rather than the market level. So yes, I think there will still be individual companies which for various reasons will come back into a valuation range where we'd say, yes, we want to own these for the medium term. So I think from an equity perspective, it will be more individual stocks and big inflows and outflows. Bigger picture, I think what we have to keep an eye on, of course, as always, is central banks around the world. As you're probably aware, they've pushed rates down to zero, negative in the case of Europe and Japan. Longer term interest rates have been pulled down as well. Personally, I think central bankers have reached a limit in terms of how far they can go with this amount of stimulus, which is very unusual. Just over the last couple of weeks in early September, we've seen a bit of volatility in markets, particularly bond markets, on the basis that people are starting to ask, well, can central banks do anything more? I think over the next 12 months we'll find out that they can't do much more, and that will probably leave particularly fixed interest markets and by default equity markets a little bit more exposed than we've seen over the last 6 months. Hopefully that is where we'll get the opportunity to buy some of these individual securities when we get a bit of this volatility. But that plus political risk in the world are the two big things that we're keeping an eye on.
All right. Well, I appreciate your time this morning, Mike. Thanks very much for joining us. For those watching, we welcome you to ring your Byron Capital advisor and discuss any of these issues and how they relate to your investments. And once again, thanks for your time.